Welcome back. We're doing a rapid fire 6-pack of subscriber requested stocks. So these stocks have nothing in common other than the fact that they were requested. They all happen to be below $10 billion market cap, but that's just a coincidence. So we're going to just do a red light, green light method for the balance sheet income statement, and then I'm going to get a rough valuation and use that information to see if I want to go deeper on these stocks in a future video. Real quick, what I have up here is just a description of all the companies we're going to do from Yahoo Finance. We're going to go through them in alphabetical order by ticker symbol. Abercrombie & Fitch, they are a clothing retail company. I think everybody knows that. ASOS or ASOS, I don't even know this company to be honest, but they are another fashion retail company. They operate online. ATKR, this one is a company that manufactures and sells electrical safety infrastructure products in the United States. That sounds like a boring company. I'm excited to see that because boring companies sometimes get overlooked. All right, Dropbox, they are a collaboration worldwide platform. That's a software company. GoPro, cameras, drones, mountable stuff, you know what GoPro does, and then Sleep Number, the mattress company. Let's get started. First up is Abercrombie & Fitch. So first up, total equity. I always like to look at this. First off, just make sure it's positive, which means that they have more assets than liabilities. And then also see if it's growing or shrinking, because that is like the net worth of the company, right? Okay, so I don't like to see this shrinking. It's kind of a red flag. All right, let's look real quick. Is it shrinking because assets are shrinking or because they're going into more debt? So total assets are shrinking a little bit. Let's look at liabilities. Yeah, this is it. They just went into a lot more debt in about 2019. So these are all the quarterly reports, by the way, from 2012 on. And I just pulled that from Yahoo Finance. All right, next up, just the number of shares. So, okay, wow, this is great. So they've been buying back shares for a while now, especially recently. So this is actually pretty good. So what makes this interesting now is that even though we saw total equity was decreasing, if they're buying back shares, there's a chance that your equity per share is not decreasing. And that's what's most important, right? If you are a shareholder, you want the value per share to be going up. You don't really care as much about the whole company. Okay, so let's see this. So this is better. So this is the tangible book value per share. And yeah, recently it's actually going up more than the equity was. So that's good to see. I actually like seeing that. Okay, so all that being said, their balance sheet gets a yellow. Let's go to the income statement. All right, before I go on, remember, this is just a very high level view. I would not go run out and buy a stock based on this. I just wanted to give you some insight into what my stock screening process looks like. All right, total revenue first. We always like to look at this, make sure it is not decreasing. Growing's better, and it is growing recently. I mean, it's kind of flat. This is okay. We'll see how their margins are and stuff. Okay, so operating margin. I know sometimes I do gross margin, especially for retail, but I'm just going to be consistent and do operating margin across the board here. I like the recent growth, but it's below 10%, so I'm not really a big fan of that. But we know they're in fashion, they're in retail. It is super hard to maintain really good margins there just because there's so much competition. So this isn't terrible, but it's not, you know, an A+ or anything like that. And lastly, we're just going to look at their income, see if it's growing on a pre-tax basis. Let me change this to dollars. All right, so our pre-tax income is pretty flat, not really losing money, so that's good. Besides the COVID quarter, and then back here it was losing money, but recently it's been okay. So I'm gonna give them yellow for the income statement too. All right, let's estimate a value here. How am I going to do that? I'm just going to take a rough estimate of the pre-tax income and multiply by 10, then ratio that to the share price. It's a lot easier than that sounded. Okay, so the average of the last 5 quarters, if I take that average, was $75 million per quarter. So 75 million times 4 is my yearly income, so an estimate of $300 million yearly income. My rule of thumb valuation metric is to take the pre-tax income, multiply by 10, and then that's kind of your new market cap, right? So if I multiply this by 10, I get 3,000 million, which is just 3 billion. Okay, so to get that to a share price, I'm going to take 3 billion, because that's my estimated market cap, divided by the current market cap, which is 1.8, and then multiply that by the share price, the current share price. That's $53. Wow. Awesome. So green there, yellow, yellow, green. I love seeing the value green. That's awesome. Let's move on. Okay, so next up, ASOS PLC or ASOS. One thing to note here is that it's in pounds, British pounds. And if you look at it on Yahoo Finance, there's some funny things with the share price calculation on Yahoo, but all I really did to make my share price was divide the market cap by the number of shares. I just felt like that was easier. So remember, we're in pounds, total equity. Look at this growth. What the heck? This is awesome, okay? So we're over £1 billion of equity. That's great. One thing I like to look at is the debt to equity ratio because, you know, you can be fooled by high equity. A company that has $1 billion of assets and $900 million of liabilities is going to have $100 million of equity. But a company that has $100 million of assets and no debt is also going to have $100 million of equity. So I like to look at the debt to equity ratio to see which one it is. All right, so the lower the better here, right? Because debt's on top, equity's on the bottom. I like to see this below 2. We are below 2. All right, this is awesome. All right, let's look at their number of shares. A little bit of dilution. It is what it is. And now I'm going to look at tangible book value per share. Okay, this is really growing. This is like the tangible net worth of the company per share. I love to see this growing. To see that equity growth and to see the tangible book value per share growth, this gets a green on the balance sheet. I don't care that they're diluting a little bit. They're growing equity like crazy. Next, the income statement. Total revenue is first. And what? Look at this. Crazy growth. One thing to note here is that I could only get the data every year, not every quarter. So I'm not going to be multiplying by 4 for my estimates. Wow, look at this revenue growth. What the heck? Okay, let's look at their margin. If this is growing too. Okay, this is low, but low margin with that much revenue growth, that's not terrible, okay? If you're growing revenue like that, I'd kind of expect you to have lower margins because to grow revenue like that, you just got to be investing so much into sales and advertising, marketing. That's the same thing, huh? But anyway, I'd definitely be interested in looking at their gross margin. I don't have it here, but still pretty strong. Let's look at their pre-tax income. Yeah, look at this growth too. Okay, this is awesome. Even the COVID year, they didn't actually lose money. They just had a down year. So this is getting a big green check on the income statement. Wow. All right, and now let's look at the value. I'm going to be conservative and just say 180, just the current one. I'm not going to project any growth. So 180. Oh, I have all this in dollars. It should be pounds. Let me change that real fast. So 180 million pounds. And remember, this is every year, so I'm not going to multiply by 4. And then my rule of thumb method is just multiply your pre-tax income times 10. So that's 1.8 billion. All right, so let me divide by 1,000 to actually get that in billion. So 1.8 billion, and then I'm going to ratio that to the market cap, multiply by the current share price. So divided by 2.2 times 22. All right, so 18 a share. Yellow. All right, this company, if you own it, don't be sad because 2 out of 3 ain't bad. And that value of 18 pound per share, that's based on me just saying that they're going to stick at that income that they have, but their growth is telling you otherwise. So I think there's a lot of potential here. This is one I think I'm going to be doing a lot more research into. Okay, let's go to the next stock. All right, ATKR. Remember, this is the boring company that sells electrical equipment. I'm excited about this one. Okay, so total equity growing. Big check mark there. I like to see that. Let me look at the debt to equity ratio. I'm trying to go it a little bit faster. My goal was to do about 2 to 3 minutes per company, but I think I'm going past that. We'll see. Okay, so shrinking debt to equity. Love to see this. This is another positive. Recently, it's below 2 if you look over here. And now let's see. Number of shares. They're about steady. I know they bought some back here, but it's pretty steady. And then lastly, tangible book value per share. Okay, this is growing. This is getting a green for the balance sheet. Awesome. Okay, let's look at the income statement. Total revenue, really high recent growth. This is back to every quarter. So I wonder if this has something to do with COVID or the freeze or supply chain issues. And if it's permanent, that's interesting. Okay, let's see. Operating margin. The margins are increasing. Well, what? So their revenue and their margins are increasing? I'll give it a green for that alone, but let me just look at pre-tax income. What the heck? Man, y'all are recommending some awesome companies. Keep them coming. Keep the suggestions coming. Okay, I'm going to be a little conservative here. I got to get an estimate for pre-tax income. I'm going to take an average over the last 2 years. So I'm not just going to count these super high values. I'm going to count some other ones too. So the last 2 years would be the last 8 quarters. That's an average of $123 million per quarter. So 123 times 4, that's $492 million per year estimate. All right, multiply that by 10. Divide by 1,000 to get to billion. So my new market cap target is $4.9 billion. Divide that by the current market cap, multiplied by the current share price, and I get $107. Okay, this one is also great. I think we're 3 for 3 so far. I was hoping to get some red ones in here, just so it doesn't seem all optimistic, but look, I'm okay with all good companies. All right, let's see Dropbox. All right, Dropbox. What the heck is this? Okay, just equity just took a dive. Is it because assets went down or we went up in debt? So let's see, assets. Okay, assets are stayed the same, actually increased, so we must have gone into a bunch of debt. Yep. I don't like that. Was the equity negative? It was negative. Okay, that just get red for that. I'm not even going to look at it any further. All right, let's go to the income statement. Total revenue growing. That's good. Let's see, operating margin. Their margin is... We got a scaling issue here. Let me just remove this one. Okay, their margin, 10 to 15%. This is Dropbox though. I would expect more for a software company, to be honest, but maybe there's a lot more expenses in managing storage and stuff than I realize. All right, let's see their pre-tax income. Not a big fan of this either. I mean, two big drops. Dropbox was a software company. Why did they get hit bad by COVID? You know, that's my question. They're getting a yellow here. Look, the revenue's growing. They're not losing money. So that's why they're not getting red, but they're getting yellow. Okay. And now let me just take an estimate of the last, I'm going to do the current 2 quarters and multiply that by 2 to get a yearly number. So the last 2 quarters added to $167 million of income. I multiply that by 2 to get an estimate for the yearly amount. So 334, and then I'm going to multiply by 10. Okay, 3.3 once I make it billion, and then ratio that to the market cap and multiply that by the current share price. Oof. 8.7. Well, I asked for a red one, I got it. I think this request was based on like, hey, the Nasdaq's taken a beating recently. Can you look at some of these software companies and see if any of them are at a deal? And Dropbox was mentioned there. All right, let's see GoPro. All right, GoPro, their total equity, recent bump here in 1 quarter. That's impressive. Let me see what caused that. Did they pay down debt? No, they didn't pay down debt. They just had a huge spike in assets. I wonder if it's because they're making a bunch of money. That'd be nice, huh? If your assets are rising like that because you have too much cash coming in than you can use, that is a great problem to have. I don't know if that's the case, but that's usually the case for it to spike like that. All right, let's see their debt to equity ratio real fast. Yeah, it's coming down less than 1. That's good. All right, and then let's see their number of shares. Increasing a little bit, some dilution. It's okay. And then tangible book value per share. Same thing that we saw with the equity. What do I do here? Okay, I'm not going to give it a green because this is a one-off, but I'm going to give it yellow. All right, income statement. Total revenue, it's not growing. It's actually shrinking a little bit, so that's not great. Let's see. I'm just going to go straight to their pre-tax income. Yeah, they were losing money for a long time. They just recently started making money. Shrinking revenue and negative pre-tax income historically. Even though they got some positives now, I'm still giving them red. I need to give an income statement red. Okay. Oh, that's not red. Green light. Red light. Okay. Let's go. Oh, I got to get a valuation. So I'm just going to take trailing 12 months. So the last 4 quarters. So the last 4 quarters add to $82 million for the year. So 82 times 10 is $820 million for the market cap. All right. If I take that market cap and ratio it down, so divide by 1,000, divide by 1.4, multiply by 8.92, I get 522 for my share price. Okay, another one to avoid. We got like the McDonald's colors going on for these 2 stocks. That's not a good thing. All right, let's go to the last one on the list. Okay, Sleep Number, the mattress company. What the heck is going on here with your equity? You're just going upside down and increasingly going upside down? What's going on? Okay, assets are rising. All right, what's going on? Liabilities really rising. Okay, so more liabilities than assets. There's no way I'll give them a green for this. They'd have to do something crazy to make up for it. Let's see. Shit. They're buying back a crazy amount of shares. Look at this. What? From 2015 to now, they went from 50 million shares to close to 20 million shares. So buying back shares is a great sign because buying back shares means management thinks the stock's undervalued if they're rational and they're trying to act in the best interest of the shareholder. So if they're buying back shares, man, that's something else. I'm not even going to look at the other equity just because it's going to be even more negative because there's less shares. Yeah. All right, this is a head scratcher for sure. If there was like a question mark, I'd put it there, but I'm going to go yellow just because of that share buyback. That's an insane. I've never seen one that high. The income statement, okay, revenue just continues to grow. That's awesome. Let's see what else. Their pre-tax income also growing. Revenue, pre-tax income's growing. Oh, I never looked at margin, huh? Let me look at margin. Decent margin. All right, this one gets green on the income statement. Growing revenue, growing income, and the margins are okay. All right, lastly, I just need to get a valuation. So I'm going to take the trailing 12 months, which would be the last 4 quarters. And my estimated yearly income is $248 million. So 248 times 10, that's 2.4 billion, 2.48 billion. So let me divide by 1,000. Then I got to ratio that to the current market cap and current share price. So divided by 1.6 times 70. Oh, hot dog. Look at that. Okay, 108.5. No wonder they're buying back shares. Okay, this is awesome. Y'all are great at recommending stocks. I really appreciate it. I'm going to be looking into these 4 for sure. I can't guarantee a video on all of them, but I will be looking into them further, and we'll see. If you got any more suggestions, I'd really appreciate you leaving them in the comments. Not only does it help me out by giving me ideas for new videos, but it also helps the YouTube algorithms as far as viewer engagement goes, right, for comments. So I appreciate you watching this. If you enjoyed it, like and subscribe. I'll see you next time.